Good morning. This is Dylan Jovine from Behind the Markets. Happy Tuesday. Today's the 24th. I was going through some old notebooks this week, and I'm moving some stuff, some boxes around. And I was going through some old notebooks, and a lot of you guys might not know, I keep a notebook every day, and basically I kind of write out what I have to do, what my thoughts are, et cetera, et cetera. And this is the one I'm using now. And I went through a notebook from 2007. And what I found, I wanted to share with you, because I don't know that you know this, but I've only made one bearish call before in my life saying basically the market is just crazy overvalued. So anyway, I look back to the rate cutting cycle from 2007, and what I found was very, very interesting, okay? Because the market's been going higher, and Lord knows that I think stocks and real estate are just incredibly overvalued. And I've obviously been warning everybody to be careful and really trying to brace ourselves for some turbulence ahead and for the possibility of a severe bear market. So I wanted to say a couple of interesting facts between this rate cut and the one that began in 2007, the last time I made a bearish call. The 2007 rate cut cycle actually began on the same day as this one, September, back in 07. We were at the same exact Fed funds rate as we are now. And the first cut of that cycle was also for 50 basis points. And I remember the result at the time was huge. The Dow Jones Industrial Average had its largest gain in 4 years. It jumped 336 points, which is the equivalent of about 1,000 points today when the Fed started cutting. And heck, I mean, even Leman Brothers shares surged back then. But as we know now, looking back, stock market was just about 3 weeks away from their bull market peak. And we know that Leman Brothers sadly collapsed less than a year later. And by the time Leman Brothers had collapsed, the Fed had cut rates 6 more times, and that didn't stop it. I mean, at the end of the day, what drives the stock market are earnings. And what drives earnings is the strength of the economy. So I was at dinner last night with a friend and with a few friends at a dinner party. And we were talking about that. We were talking about, can the Fed save the economy? And the jury's still out whether the Fed could save the economy. What I do know is that by any measure of value anyone wants to use, stocks and housing prices are historically high. Matter of fact, real estate, housing prices right now are higher than they've been since records have been kept in relation to income since 1980, just regular housing prices. And we know what happened the last time that happened. And I even remember looking back at my notes from 2007, and I wrote down, I remember this article in the Wall Street Journal where the title of the article was, "Don't Panic About the Credit Market." And this was written from the chief economist of Bear Stearns at the time. I won't say his name in public, but he wrote that in August 2007. Ouch. Bear Stearns, of course, went bankrupt. Lehman went bankrupt, and the credit markets were destroyed. So I guess what I'm trying to do here is something that I've never tried to do before. And that's really bring you inside my mind so you can understand the risks going on and the potential for opportunities here and there. And I'm trying to encourage you. So that really creates kind of a binary thinking, split screen thinking that I'm trying to share with you, my split screen thinking about this. So most people in my shoes, they're just going to tell you, just go bullish or go bearish, but only a fool is permanently bullish or permanently bearish. I think one of the things that I've learned as an investor is to look at the facts on both sides and really make decisions based on that. And I just want to caution those of you watching this and reading this to be careful and not get caught up in this euphoria. This is a dangerous time for the markets. Now, where it goes, only God knows the answer to that. But this is a time when the risk factors have risen and it pays, it makes sense just to take more of a risk-off stance with some of the more aggressive plays, and also feel free to take profits. Because again, you can have 100 experts on TV saying, oh, the party's back on, this is great, market's going to 50,000 or whatever it is. I've been there before, I've watched these. And let me tell you, I know many of these types of people. In person, they are not impressive. They're part of the whole entire Wall Street machine designed to keep you interested, like a slot machine, like a bunch of lights that just keep buzzing. The Wall Street machine is like a slot machine. Everybody talking is just like a bunch of different lights that keep people just fascinated on the game. And it really is important not to fall for those lights, to focus on the things that matter most, like what is a company worth? What do I have to pay for it? Where is this market in relation to history? And when you ask yourself those questions, when you ignore the talking heads and ask yourself those types of questions, what you will find is that, again, by any measure of value you want to use, the market is historically high. Having said all that, you got to play the ball where it is, not where you think it should be. So we're going to play the ball where it is. That means we're going to find some new opportunities here and there have been, specifically in energy and some AI infrastructure and other things like that. And we'll keep telling you about them, and certainly in biotech. We'll keep telling you about them. But remember, when you're listening to the other people that you listen to, just listen to it with a grain of salt. I don't want you to risk your savings or the nest eggs that you have. That is the most important thing. I just can't emphasize that enough. The name of the game is to protect our nest egg. Anyway, that's all I have today. Have a wonderful day.